Hey guys, a little bit different on this one. I'm going to do a quick intro. We're going to look at three stocks in the telecommunications business that are very, very similar in the industry. And we're going to compare which one has more value. Because price is what you pay when you buy a stock, value is what you get. We're going to see if we can figure out how to understand that. Okay, so here we have three tabs open. One is for Rogers Communications, one is for Bell Canada, and one is for Cogeco. All three are priced relatively the same, and they all operate in Canada and the US in telecommunications of some type, internet provider, phone, cellular, you name it. So we're going to take a look at why, $58.35 might be a better value than $50.53 or $60. First place we're going to stop here on TradingView, by the way, which is a site that I use quite often, is down here. We're going to look at market capitalization, which is the amount of shares multiplied by the amount of, the share price gives you a total market capitalization, and you can sort of do an approximate size comparison. So we can see $500 million, give or take, for Cogeco. We've got $46 billion for Bell Canada, and we have $32 billion for Rogers. So right away, you can see that some are much bigger than the others, yet the price is roughly the same. And that's because the value in every share is slightly different. And the next thing we're going to look at, starting back at Cogeco, is the price to earnings ratio. So one share of Cogeco earns roughly $4.05 every year, or it did in the past 12 months, over the past 12 months. And so that means that when you're paying full price for it, which is $58.35, you're paying a multiple of $14.38, which is pretty good. Anything below 15 is usually considered good. 15 to 25 is a bit high, but if it's a really good company, that's okay. And above 25, generally, I would stay away from. So 14.38 for Cogeco, and then we have 22.16 for Bell, and then we have 36.63 for Rogers. So now you can see that we're paying higher multiples of the earnings for the other companies that are bigger. So in this case, the larger companies fundamentally have less value per share, even though they have a higher price per share. And you can look at this very quickly. Now, Rogers pays 3.32% dividend. Bell pays a 7.91% dividend, and Cogeco 5.89. This could weigh, but it's not big enough in this case to actually go into this and say that Bell is better because it has a more dividend, even though you're paying a higher multiple on the earnings. So anyway, this is just a quick way to show that price is what you pay, value is what you get. I encourage you to use TradingView. It's free. You can create an account if you want, but you don't have to, as long as you're okay with it. Well, there you have it. Small fundamental analysis, very, very small fundamental analysis, or part of it. There are definitely more points we could look at. I just want to keep this very short and sweet. We're going to look at other things like price to book and stuff like that on other videos, but I thought I'd show you guys just how to compare something, put everything as apples to apples when it might not be so evident. Thanks.